Time to get focused with Focus on Investing.
Microphone check, microphone checker. Throw your ones in the chat if I can be heard. It's, what time is it now? 8:07 on the 5th of June 2022. You're getting ready to do another technical analysis trading session. Salute to Stun Legacy in the building. Yeah. Salute to Jeremiah L in the building. Yeah. How is everybody doing on this fine Sunday? I hope Sunday is treating you good. I don't know if you guys do Sunday dinners on a Sunday. I don't know. It depends where you are, innit? So I know some people do their Sunday dinner early. Some people do their Sunday dinner around, 1 p.m. Some do it a little later, around 5. Some are evening eaters. So here is 8 p.m. GMT. I think it's 3 p.m. Eastern, and it's 12 p.m. Pacific time. So I don't know what time you guys have had your Sunday dinners, but yeah, if you guys have had your Sunday dinners, I hope you guys are settled in and ready to go in for another trading session. Yeah, we missed out last week, but what we're going to touch on today it kind of follows on a bit from what we did with our last session. Was about 2 weeks ago. If you don't know, if you didn't see our last session was essentially speaking on, how you can level up your trading knowledge. See, here at Focus on Investing, we're not just trying to sell you trading or sell you, how technical knowledge or how to read the charts, right? We're here trying to sell you, not even sell you. We're here to teach you how to become experts in technical analysis, right? So on our last session, we went through and broke down, how a lot of these, trading gurus online, they tell you a truth, but they tell you only the half truth, right? They tell you only part of the story. And, if you're not an expert, you don't really understand trading, then you won't actually really understand the full picture of what they're telling you, right? So you're only understanding half of it. So, here at Focus on Investing, we're here teaching you how to become experts and being able to read the charts and read indicators. And so when somebody talks to you about trading and about their trading plan, you can easily define or differentiate what is the real from the fake, separate the weak from the obsolete, So last week, or I should say 2 weeks ago now, we broke down about a risk reward in trading, right? How do you calculate your risk reward within your trades? And we spoke about, some people have a certain risk reward ratio in their trading. Some people risk 2 to get 1, so they basically make a 50% of what they risk. Some people, risk 1 to get 2, so they get 200% of what they risk. Some risk 1 to make 3, so they make 300% of their risk. But we broke down how you could make infinity and beyond. We had an infinity and beyond risk reward set up, and trading is a wholesome skill, right? If you know how to trade properly, and you understand, proper edge creation and management, you understand that it's a wholesome skill, right? And the reason why I say it's a wholesome skill is because there are many different disciplines and skills and things you have to learn in order to create a wholesome strategy. It's like, like one section links onto another. It's like a bike chain. Think about a bike chain. Each little link links into the next link, that links into the next link, that comes back around to the first link, right? So it's about having a wholesome strategy where you design a 360 strategy that covers all angles of the trade, right? So, with our focus on investing strategy, you can actually lose more trades than you win and still make money, right? And the likelihood of you losing a trade is actually quite small, right? So this is about all aspects of trading. But the reason why I say it's the 360 part, like if you get a proper trading strategy, can't really take one slice out of the puzzle, right? It's like if you think about a business, right? When you run a business, you have the product development side, you have risk management, you have HR, you have all of these different elements, right? And all of these elements together build together a successful, wholesome company, right? So when you think about a company, if you was to have a great product but terrible marketing, it's unlikely that that product will actually get out to your customers in order for the product to sell well, right? The other thing is as well, if you think about, if you remove the product side of the game out of the company, what you end up is, a lot of people getting aware of your company, a lot of people getting uh pushed towards the company that you have. But when they actually try your product, because you've dipped down on the product management side of the game, then they will finally find out that your product is whack, and then they won't buy your product. So it's a combination of both of them together that works together that allow you to have a successful company, right? The issue with trading is, people like to pick out the bits that sound good, the bits that they like, the bit that's nice, it sounds nice to them. So they like to take the bits that are exciting and take and remove the bits that are the kind of the discipline bits, right? But often the discipline bits are the parts that really secure your trading, right? It's one thing to generate lots of money with trading, but it's another thing in order to protect the money, right? We always err on the side of, capital preservation and risk management. We're not gambling out here. We're not just trying to risk it all and trying to get as much money for the least amount of our buck. No, we want to have a wholesome strategy where we can build a long-term income stream from our investment strategy, right? So in order to do that, you need various different elements of trading. So so we're going to talk about today um why day trading is losing people money, right? Because day trading is a specific type of trading when you're trading the markets, right? And it's often the first type of trading that people get into. When people first learn how to trade, they learn how to do day trading. Me myself, excuse me, I started doing forex. And for those who don't know, forex stands for foreign exchange. It's basically where you make money off of trading currencies between each other, right? And it's really the differentiation or the difference between the value in two different currencies. So as each currency goes up and down in relation to each other, it creates movement on the charts. The charts plot the difference in between, the exchange rates between currencies. And as they move up and down, you can speculate or you can put money on which direction the exchange rate is going to go. Is it going to go up, as in the exchange rate is going to increase between the currencies, or is it going to go down? It's going to decrease between the currencies, right? So this is how you make money in forex. So when I first got into the trading game, I first got into forex, right? And what I did with the forex was I was doing day trading. It was a day trading exercise that I did with forex, right? So, um, you know, when you're doing day trading, you're working on smaller time frames, right? So let me bring up my chart right now so I can give you a bit of illustration. Where are we here? Chrome tab. There you go. You should be able to see that. Let me bring up this screen. I know before we do that, let's do this. That's not the one I want. There you go. All right, let's get the formalities out of the way. If you haven't done so already, please hit the subscribe button. Also, when you come through the door, pay your respects and hit that like button. And also, if you would like to support the show, you can hit the Cash App, which is £, focus on investing. That's £, focus on investing. If you find this information valuable or you just want to support me in the stream, then you can hit the Cash App, which is £, focus on investing. All right, so here at Focus on Investing, this is our template. We have our 4-screen setup. We have our monthly time frame in the top left corner. We have our weekly time frame in the top right corner. We have our daily time frame in the bottom left corner. And we also have our daily time frame in the bottom right corner. You will see that we have a number of different indicators on each one of our charts. These are custom indicators by Focus on Investing. They're proprietary indicators that are custom coded by us that show us specific things about each one of these charts and each one of these time frames. Currently, for example purposes, we are looking at the US 100 index, ticker symbol NDQ. All right, so in our setup, we use this 4-screen setup, which includes the longer time frames, right? But typically, when you're using day trading, you will use smaller time frames, and you often see this with many day trading setups. So if we go and look at TradingView, we can see that we have a whole different amount of ranges of time frames that it can show. We can show anything in terms of days. We can show from 1 month, 1 week, or 1 day. We can show 4 hours, 3 hours, 2 hours, 1 hour. We can go below that in terms of minutes. We can show 45 minutes. We can show 30 minutes. We can show 15 minutes. We can show 5 minutes. We can show 3 minutes. And we can show 1 minute, right? And here's the thing, right? So for this example, we're going to choose this frame in the bottom, which is our bottom right. So we're going to change this one to our 1 minute. So typically when you do day trading, you typically go with lower time frames. So usually the highest you go for is 1 hour. You don't really use the 1 day. The typical use is 1 hour, but the most commonly used is the 1 minute time frame, right? So this is the 1 minute time frame, right? So again, using smaller time frames is usually what's done by day trading. So why is it called day trading? It's called day trading because you typically enter into a trade, and by the end of the day, you close your trade. Now, on the off charts, on the odd charts, if the markets go in a certain way on a certain direction or have a certain type of setup, what you tend to find is you can have a trade that opens for longer than a day. So you might be in a position. All right, so let's see those who was paying attention last week. What are our 3 positions in trading? When we set up a trade, what are the 3 values, or what are the 3 prices that we typically set up on a trade? It's like the 3 elements of a trade when we're getting in. Let's see if you guys remember from last week. I know if you remember last week, I drew 3 lines on the charts that represents 3 elements of a trade, or the 3 properly structured elements of a trade, right? Let's see who remembers, who's been taking notes, right? Who's got a pen and a pad, who's been writing down notes. What are the 3 numbers that you look for when setting up a trade? Or the 3 prices? The question is, Yeah, this is the interactive session, ladies and gentlemen. So I don't think you're just gonna come here and kick back, and you're not gonna work that brain. You're not gonna learn something today. You're gonna learn today. What are the three prices that we look for when setting up a trade? You can have a stab at it. Don't worry if you get it wrong. We're all here to learn. The question is, when setting up a trade, what are um the three elements? Jeremiah L says, I think I missed that discussion. It was 2 weeks ago. I don't know if you saw 2 week session, if you watched the replay, if you were here. Maybe you didn't. But to be honest, if you trade any form of trading, whether it's stocks, if it's crypto, if it's forex, if it's commodities that you're trading, you should trade with these three prices. People don't know. All right. Let me tell you what the answer is, or illustrate what the answer is. Okay, let me change this back to a daily time frame, and we use this chart. Let me change this back to the daily time frame. Or we can use the 1 minute. No, let's stay on the 1 minute. So the three different elements of setting up this is a correctly structured trade, right? The first thing you will want to know is, what is your entry price? So we've got in our Focus on Investment Academy, we've got certain indicators that we've custom coded for, right? So in this on this specific asset or trade, we've got what we call our Focus on Investing entry indicator. So this basically indicates whenever you want to enter into a trade, we have already, depending on the trade. Now, this is specific to each, asset. So depending on if you're trading forex, if you're trading cryptos, if you're trading commodities, if you're trading stocks, right? Each asset is different, and even within each stock. So if you're trading Amazon versus trading Netflix versus trading Tesla, right? Each one of those stocks are different, right? And the reason why they're different, each stock or each chart pattern represents the value of a company. The value of a company is different depending on that company, how it's run, what product it has, what sector it's in, what industry it's in. All of these things factor into, you know, how the value of the company is calculated and what it does, what the management team, if they're good, if they're bad, all of these things. So all of these things are factored into the price or the value of the company, right? So because you have different companies, and different companies are run differently, and are in different sectors, and different market factors, affect you know different companies differently, the charts of each of these companies are going to act and react differently, right? So with that in mind, you have to, whenever calculating or using any kind of strategy on these charts, you have to use a again, you have to utilize a strategy that adapts to the individual nature of each of these charts, right? So it doesn't make sense, using a certain strategy that works for Amazon, but it doesn't adapt to what Microsoft does, right? So when we're talking about Focus on Investing, and we're talking about our specific indicators, these indicators are indicators that utilize code. And these code utilize specific calculations based on each one of the stocks, right? And part of the calculation in the stock it is calculated based on the specific stock's volatility. So what is volatility? Volatility is the movement on a chart, right? So if you see a chart that moves up and down rapidly and quite wildly, we say that chart has high volatility, it's highly volatile, right? It moves up and moves down quite quickly. If you have a chart that you would call low volatility, a low volatility chart would, most of the time be quite flat, but if it does move, it doesn't move up and down very quickly, right? So, you know, if you have a chart that has high volatility and a chart that has low volatility, let me ask the chat, why would you trade those two charts differently? Let me see if the chat knows. Why would you trade a chart that has high volatility differently to a chart that has low volatility? Let me see if chat knows. The question is, in trading, why would you trade a chart that has high volatility differently to a chart that has low volatility? Let's see if you guys know. So D says unpredictable. Okay. Do you have any other answers? Anybody else want to chime in? The question is, one more time, why would you trade a chart that has high volatility or asset that has high volatility different from an asset that has low volatility? Give you guys a few more seconds to answer. Okay. All right, I'll give you guys the answer. So D was actually correct. It's unpredictable, but it's not necessarily that it's unpredictable. It's more that the unpredictable is correct, but the reason why it's unpredictable, it's not that it's unpredictable, right? If we know that a chart has high volatility or an asset has high volatility, right? We know that it's predictably unpredictable, if that makes sense, right? Because we already have established that it has a high volatility. So any asset that has high volatility or any chart that has high volatility, it's going to spike up, spike down, and whipsaw back and forth, right? So it's unpredictable, but it's predictably unpredictable, right? The reason why you would trade a volatile chart different from a non-volatile chart is because, and this kind of goes into, what we're talking about are three elements of our trade. So we'll answer it as we answer the three elements. So the first element here, we have our green line on our focus on investing entry indicator. We've actually calculated the price of these three elements or these three lines that you need. So the first line that you would need, or the first element here, which we have highlighted in this dashed green, let me highlight more. There you go. This dashed green line is our first element of the trade, and our first element of the trade, if we highlight it, is our entry. That's our first price that we need. Our first price is our entry price, right? So I'm going to highlight this in green. Our first price that we need to know about whenever structuring a trade correctly is our entry price. The second price that you need whenever entering a trade, is represented by this gold dash line. And this gold dash line, if we highlight it here, would be, so in most trades or in most kind of trading setups, that line here, if we highlight it in green, would be what they call your target price. So it's essentially the price that you think, or the price that you think that the chart is going to rise to, and where you will take your money, or where you'll take profit, where you'll bank the profit in your trade. They call it the target price. It's the price on the chart that you're targeting with your trade or with your risk that you put in. The last one is represented down here with this dashed red line. And this price here is called our stop loss, right? Our stop loss is our third line or a third price, right? So these are three key elements that make or are set up for a correctly set up trade, right? You have your entry price, which is the price that you will enter the trade at. We have your take profit line, which is the price that you want to, bank your profit as price moves to that level. And then you have your stop loss. We have our entry. If our entry moves up to our take profit, we're in profit and we bank it. If our entry moves down to our stop loss, it's gone in the opposite direction to what we would like to go in, and we will cap our risk or our loss with our stop loss. Now, bear in mind, this is ordered in a bullish trade, right? This is in a buy opportunity. But the question is, how do you, or where do you put these lines, right? Where do you calculate these prices, right? And with Focus on Investing and our indicator, our indicator is based on the volatility of each one of these assets, right? Because you can calculate with a number or a measurement what the actual volatility of a stock or an asset is, right? So within the plotting of our indicator and exactly where we plot these lines, the volatility is calculated within the position of each of these lines. So the reason, again, so going back to the question that we had before, the reason why you don't use the same strategy on a high volatility asset as a low volatility asset is because when you're placing or positioning your stop loss, you want to position your stop loss in a place where it allows the trade or price to breathe, right? When we're looking at price never moves in one direction, right? So if we're looking at our chart from here, going from 8:24 on the 3rd of June, and then we're looking at price or at the 3rd of June or at 8:59, we can see that price never moves in a straight line, even though it moved upwards. Let me get our indicator, arrow. We can clearly see that price moved upwards, right? During that time frame, but price never moves upwards in a straight line on a straight direction. We can see here from this part, it moved up, it went sideways a little bit, it spiked up, came back down, dipped down, pull back up, dip down again, pull back up, and then dip down again, right? So we can see that this kind of area of price action was quite turbulent, whereas this area here was not very turbulent. So this area had low volatility and this area had high volatility, right? So we can see that price never moves in a straight line, right? It always pulls back a bit before it moves in a straight line. Sometimes it spikes forward and then it pulls back itself, right? So knowing this about price, whenever we want to place our stop loss, we want to place our stop loss in a correct position. We want to place it in a place that is not too low, as if it's too low, it will cause us to incur higher losses, right? But if it's too high, and it won't give price the space it needs to breathe, right? Price needs space to pull back a bit and go forward. Now, if your stop loss is too tight, so let's say, for instance, this is our example, right? If we were to move our stop loss up and say, this was our price level, right? We would expect price to move up higher. If we go back in our DeLorean, pull back, we can say we went back to this day. Now let's go to the next day. Yeah. So to say this is where we're at with price, right? We're going to use, as you can see in this chart, we're going to use natural formations in order to act as our stop loss, right? Or to indicate where we're going to position our stop loss, right? What you notice in any sort of asset or trade, there are support levels and there are resistance levels. Long story short, support levels are where price tends to rest at without going any further lower. And resistance levels are natural areas in price where the chart tends to have trouble going any higher. So if we look at this chart here, we can see that we have a support level right where this red line is. If we look at this red line, we can see that a lot of the candles or the bars stop at this red line. It comes down, it stops. And remember, support levels aren't exact numbers. They're like areas. They're like areas of support and areas of resistance. So if we look here, roughly 1, 2, 3, 4, 5, 6, 7, 8, 9. All 9 of these bars stop around this 1, 2, 5, 3, 5 area, right? This one, it stopped slightly lower. This one stopped exactly on the line. This one stopped slightly higher. This bar here stopped exactly on the line. This bar stopped exactly on this line. This one was a bit more higher, so you might not say it didn't exactly stop on the resistance line, but it's not far from the line. This one here stopped exactly on the line. This one wasn't far from the line, and this one was exactly on the line, right? So whenever you're placing your stop loss, you want to place your stop loss. You want to have, if you can, a natural support level in between price and your stop loss price, right? So your stop loss price, right? The reason why you want that is because you want the natural support level of price to act as a barrier or resistance before it gets to your stop loss, right? You would like ideally price to bounce off of your support level and turn around before it hits your stop loss, right? Nobody wants, their stop loss to be hit. However, you prefer your stop loss to be hit rather than you make endless losses on the trade, right? So the ideal placement of a stop loss is slightly below the line of support, right? So what you're saying is, if there's a natural resistance to price going lower on the charts, you want that in between price and your stop loss, simply because if price ends up breaking through that natural level of support, then it's highly unlikely that price is going to go in the direction that you want it as favorable. So therefore, if it's broken this natural barrier of support or this natural level of support, then you want it to hit your stop loss, because it's more than likely not going to go in the right direction, right? So you would naturally place your stop loss at below this natural level of support, right? So imagine we'd have done this. We'd have placed this is what they would call a tight stop loss. So a tight stop loss is a stop loss that's really close to the support level. So let's say, for instance, we did this in this chart. As we move forward in price, we can see, we had a massive spike up, so we expect price to go up. Price then pulls back. We go forward a few days, and then bam, we would have been stopped out of our trade at this point here. Price is broken below the natural support level of this chart, and it has now hit our stop loss. So you may think that, okay, this is great because price has gone in the opposite direction to what we wanted it to go. But if we continue, right, it's broken down quite deeply. If we continue, bam, price came straight back up above that, right? We keep going forward. And if we press play, we can see that price came all the way back up to here, right? So in the grand scheme of things, this pullback or this dip was just the natural pullback of the flow of price. Price had the intention of going higher, but it just pulled back first before it went higher, right? So if you place a tight stop loss, the issue is that, a tight stop loss doesn't give price the space it needs to breathe, right? Price needs space to breathe in order to pull back and do its natural pullback in order to continue on going higher, right? And if your stop loss is too tight on the trade, what happens is you get stopped out of the trade early when you could be correct in the direction that the trade is going to move, but you've just placed the stop loss too tight and stopped yourself out of the trade early. So this is why you don't put the stop loss too tight. Why you don't put the stop loss too wide, we spoke a bit earlier about this, is because, the wider you put the stop loss, the more risk you're adding to the trade, right? Don't forget, your trade is based on the amount of points or pips or the price, you pay for each, penny or dollar or whatever you pay. that the price moves. So the more it moves in the opposite direction to you, and the more space you give it to move in the opposite direction, the more loss you will have, right? So you don't want to have the stop loss further from price than it needs to be, because if you're wrong about the trade, you want to be stopped out of the trade early. So leaving a too wide stop loss will make you incur more losses than is necessary, right? So the reason why you need to calculate volatility within your placement of your entry, your stop loss is because, again, too much space and you incur too high losses, and too little space, you'll get stopped out of your trade early. So this is why whenever you're having a trade strategy, you have to calculate the volatility of the trade inside the placement of your stop losses and your entry, right? So with our focus on investing custom coded indicator, we've automatically calculated those prices for you. And within the calculation of those prices is the calculation of volatility for the trade, right? So if I delete these lines again, you can see on our indicator, wherever these dashed lines are placed, this is specifically calculated the entry price specific to this asset. In this case, it's the NASDAQ, the US 100 index. We've specifically calculated what would commonly be our take profit line. We don't use take profit lines in our trading strategy, but for the purposes of illustration in this, that's where it would be. And in calculating our specific stop loss, the specific placement of this is also calculated with our volatility. All right. So, so the three lines you would like to place in trading is important when you're talking about doing day trading. So day trading, you typically want to enter a trade and exit the trade at your take profit line within a day, right? So this is why they call it day trading. It's within the same day that you enter that you likely would like to exit the trade. Now, sometimes what happens is the trade or the day, you have opening hours for each day that the market is open. So the market opens at a specific time and it closes at a specific time. So ideally, you would like to enter your trade and exit your trade within that specific day, right? But sometimes what happens is maybe there's low volatility in the market, meaning that there is not a lot of movement in the market. And what will happen is the day will close, or the market will close before you've either reached your take profit line or before you've been stopped out of your trade, right? So, the typical idea of day trading is the trade is to be completed in that one day. When I used to do when I first started trading and I was doing forex trading, I used to have to wake up at 5 in the morning, and prepare my trade before the market opens at 7, right? So the reason why I don't do day trading anymore is because I found a better solution to day trading. So what is the better solution to day trading? The better solution to day trading is trend trading. So what is trend trading? The difference between day trading and trend trading, or what we like to call long-term trend trading, is that you do not enter and exit the trade within, or the expectation of entering exiting the trade is not expected within one day of trading, right? You're not expected to enter into your trade and exit from your trade within the same day, right? So this is the difference between day trading and trend trading, right? With day trading, the issue is, if you understand about charts. So again, this is the 1 minute time frame. You can't tell the difference between a 1 minute day. If I change all of these time frames, you can't, if without looking at this number at the top, you can't tell the difference between each one of these charts, right? So if I do the 1 second and I refresh it, maybe it's a bit small. All right, let me come back to that. It's a bit small for you guys to see. So this is the 1 minute chart. This is the 3 minute chart. This is the 5-minute chart. This is the 15-minute chart. Remember, this is the same asset. We're just looking at it on a different time frame. When I'm changing the time frame, what it basically means is that each one of these bars represents that specific named time frame. So in a 15-minute chart, each one of these bars represents the price movement over 15 minutes, right? If I hit the 30-minute chart, you can't tell the difference. Now, if we didn't have the labels, there's no way you could tell what time frame we're looking at. This is the 45-minute charts. Let's run through all of these. This is the 1-hour chart. This is the 3-hour chart. So this is the 2-hour chart. This is the 3-hour chart. This is the 4-hour chart. This is the 1-day chart. This is the 1-week chart. And this is the 1-month chart, right? Without any labels of as to what chart it is, you can't inherently look at the price and tell, at what level we're looking at, right? And that's because, price charts are what they call fractals. If you know what a fractal is, put a 1 in the chart. In the chat, talking about the chats. If you don't know what a fractal is, put a 2 in the chat. Jeez. Put 2 in the chat if you don't know what a fractal is, and put a 1 in the chat if you know what a fractal is. When we're talking about various different time frames of charts, we're talking about the charts being fractals. Put a 1 in the chat if you know what a fractal is. All right, we got Jeremiah L, knowing what a fractal is. We got D, who doesn't know what a fractal is. Anybody else want to get going to give an answer if they know what a fractal is? All right, let's go and look at the definition of a fractal, right? Let me go to screen. Let me share this page here. So we're going to go to fractal definition, right? So the definition of a fractal is it's a curve or geometrical figure, each part of which has the same statistical characteristic as the whole. So this is what is key. Each part of which has the same statistical characteristic as the whole, right? So what that basically means is each part of it looks the same as the whole of it, right? So it's essentially something that you can't really tell how far zoomed in you are, right? So I'm going to show you an illustration of a fractal. If I share my screen. Here we are here. So these are images of fractals, right? These are weird shapes, and some of them are very specific to certain things, right? This is like a cardioid fractoid, right? A cardioid fractal. But if we look at the animated GIF of a fractal, you can see why they call it a fractal, right? It's like endless zooming, right? No matter how much we zoom into it, you can never really tell at what level you're at, right? Because each level of the zoom, the more you zoom into it, you look like you're not really moving anyway. You're not looking like you're getting any closer, because even as you zoom into it, the zoom part looks the same as the unzoomed part, right? If we look at our original image here, which is this highlighted GIF, this is our furthest zoomed out part of the fractal, right? And this has been running for about a minute now, zooming in, yet you could not really tell the difference between the super zoomed in version of the fractal and the super zoomed out version of the fractal, right? So this is what we call fractals. Fractals are something that you can't really tell how far zoomed in you are into whatever you're looking at, right? So if we to go back to now the charts, let me stop this. If we to go back to the charts now, pull back up our chart again. When we're looking at the various time frames, this is the monthly time frame, and this is the 1 minute time frame. This is a super zoomed in version, right? So let's go back to, again, the monthly. From the monthly, if we go to the 1 week and the 1 day, we've just zoomed in 3 times on these charts, yet we can't really distinguish from each of the charts, you know, how far zoomed in we are, right? So, you know, charts are fractals. There's no way of telling, you know, how far zoomed in we're getting with each of these time frames moving forward. Remember, as we make the time frame on the chart smaller, we're actually, you know, zooming into each one of these bars. So for instance, if we look at the 1 month time frame, the bar that we're looking at the end is 1 month, right? 1 month is 4 weeks, right? So if we go from the 1 month to the 1 week, we've actually split that bar into 4 different sectors. So now that 1 bar is encapsulated in 4 different bars, or 4 different bar time frames, right? So those 4 different bars now represent what was in that 1 bar. So each time we lessen the time frame, we're actually zooming in on each one of these bars to a greater depth, right? And what the greater depth does, it gives us more detail to what the actual price is doing over a certain period of time, right? The further out you're looking, the more of an overall view you're looking at that specific time frame. The closer you're zooming in, you're looking at more of the minute details, or the minute movement in price, in order to get more details, understanding of the price, right? But notice something when we're moving in. We spoke about volatility earlier, and under identifying and recognizing volatility, right? When we're looking at this chart here, this is our furthest zoomed out chart. This is the 1 month chart. Notice how there's only one real spike, and we can see on our screen. We move up, which is the spike up, and then we spike down. It's really one spike, one flick of volatility. All right, keep that in mind. One movement of volatility. As we zoom in on a smaller time frame, on our 1 week, in our frame window, we are now seeing what you would call maybe 2 spikes of volatility, more than 2 actually. You've got 1 here, spike up. You have our spike down. You know, you have probably a spike up here. We have a spike down. We have another spike up here. We have another spike down here. We have a big spike up here. We have a spike down again. We have a spike up here. And then we have another spike down. So if we count the peaks, we can say maybe 1, 2, 3, 4, 5, and maybe 6. So, you know, by just halving our time frame, or halving the chart in half, we've actually increased the volatility times 6, right? So that's just going by 1 time frame. So just keep an eye on how much the volatility increases the more we zoom into the chart, or the more we reduce the time frame. So if we go to 1 day, we can see more and more increased volatility. Pay attention to volatility again as we go to 4 hours. We go to 3 hours. Notice how each of these charts look slightly different because we're seeing more volatility. 2 hours, 1 hour, 45 minutes, 30 minutes, 15 minutes, 5 minutes, 3 minutes, and our final chart, which is the 1 minute. So look at the difference. Look how much volatility is in this 1 minute. We've got a spike here, 1, 2, 3, 4, 5, 6, 7, 8, 9. Could say possibly 10-ish, 11, maybe 12, 13, 14, 15, 16, 17, 18, 19, 20. So we went from a chart that had one spike. Remember, this is all the same asset showing, overall the whole time frame. We're just zooming into smaller elements of this time frame. We've gone to what did we say? 20 was here. So we went from one spike in the chart to 20 spikes in the chart. So what you notice is as you zoom into the charts, you actually increase the volatility because you're zooming into the more minute details of price as it moves over time, right? What happens is as you increase the volatility, you do two things, right? The reason why you can get in and out of a trade in one day when you do day trading versus if you do long-term trend trading is because there is so much movement on a minor scale that the increased volatility allows price to move the chart more, right? The increased volatility is essentially the chart moving more than if you look over a greater time frame. As you look at a greater time frame, it's actually smoothing out the individual movements of the chart, right? So because there's more volatility on the lower time frame, you can get into a trade and get out of a trade quicker, right? So this is how you're able to trade and bank money from the trade every day, right? But remember, when you increase, the volatility, you increase the risk, and when you increase the risk, you increase the reward, right? So what it essentially allows you to do is to incur more risk on a daily basis and bank more profits on a daily basis, right? So you would think that is great, that's a good idea, but here is why it turns out to be a bad idea, right? The aim of trading, right, is to preserve as much as your capital as much as possible, right? Any investment is about putting as little investment money or as little seed money as possible and getting as high a return as you possibly can, right? The issue of why you shouldn't really be doing day trading is because every time you place a trade, you place a trade through a broker, right? And in order for the broker to get paid, the broker takes what they call is the spread. And the spread is essentially, you know, the broker doesn't offer you the actual price of the trade, right? Depending on whether you're buying or selling the asset, or whether you're predicting that the price of the trade is going to go up or down, the broker will actually not give you the exact price, but they will give you. So if we're gonna buy and we're expecting price to go up, they will give us a slightly higher price for the asset than is actually costing them, right? So what basically they're doing is they're taking those first few, pips or points, or the first set of money goes to the broker. They get paid on commission, right? So they're getting paid on commission first when the chart moves, and they receive it before you receive it. It's kind of like the taxman, right? Whenever you get your paycheck from work, the taxman gets paid before you get paid, right? They take their money out first. So it's essentially what the broker is doing. When the price goes up and you earn a profit on the chart, the broker takes the first few points or pips for themselves and banks that, right? So this is what they do, right? So when they bank the first set of money, they get that from each of your trades. So why do most trading outlets and why do most brokers encourage day trading? Let me see if the chat knows. This is a question for the chat. Why do most brokers, knowing what you know, why do most brokers encourage day trading? Now discussing what we just discussed and knowing what you now know, why do you think most brokers encourage day trading? Speaking about what we just know, what we just said, and what we just know, why do most brokers encourage day trading, and why is it a trick bag? you know, Brokers aren't necessarily your friend. We need them in order to enter the markets, but they ultimately don't really work with us. They kind of work against us, brokers, right? And all's fair in love and war and trading. You know, they're doing their job. They got to get their piece out of the game or out of their pie. You know, but understand that they are not working in your favor. These brokers, right? So the question again is, why do most brokers encourage you to do day trading? D says you got it. D says more profitable for the broker. That's correct, right? But the reason why it's more profitable is because typically in day trading, right? If you're doing day trading, it's highly unlikely that you're going to place one trade per day, right? You're usually going to place, you know, anywhere from 0 to maybe 4, sometimes up to 6 trades a day. You're gonna do what I used to do is I used to wake up at 5 in the morning, research the charts. I think you should get ready and do whatever, research the charts for an hour or so, place my trades, and all of that sort of thing would take me up to the opening by 7 o'clock in the morning. By the time the markets open at 7 o'clock in the morning, I would have already had all my trades set up, my charts placed, my positions, everything like that set up from early in the morning, right? So when you have that by the end of the day, usually by lunchtime, more time, when by the time lunchtime rolls around, I've already entered in the trade, either made my money and got out of the trade or been stopped out of the trade and gone. So the reason why brokers would encourage you to do day trading is because that is 6 trades that you've placed in one day. Remember, the broker gets paid for each one of your trades, no matter whether you win, lose, or draw. The moment the trade gets entered into, you pay the broker, right? That is how the broker gets paid. So brokers will encourage you to do day trading because they get paid each time you enter into a trade. So this is again why you don't want to do day trading where you're placing trades every day, is because every day you're spending money with the broker, and every day you spend money with the broker, the more debts you're incurring, or the more outgoings that you're incurring, the more liability you're spending. So that's the first reason. You are entering more trades every day in order to place your trades, but again, you're paying more in commissions by going daily with the broker. So that's the first reason. The second reason is, you know, when you're doing day trading, as I spoke about, it's hard. It's hard on your time, right? Your time is your most valuable asset. We all know the worst way to earn money is exchanging your time for money, right? So the whole idea of investment is about leveraging your time to make as much money as possible, right? If you have to sit there every day for hours looking at charts, watching prices go up, watching prices go down, you know, prices fluctuating by the second, by the minute, you know, you are not exchanging, or it's not a best use of your time, right? Essentially what you're doing is you're going from, you know, trading your time for money, you're going into leveraging income. So essentially you still have a job. Your job now becomes watching charts. Your job becomes watching price go up and down and up and down on charts. All you're doing is, yeah, you fired your boss, but now you employed yourself to watch charts. As the wise philosopher said, ain't nobody got time for that, right? Who's got time to be sitting there all day looking at charts go up and down, right? It's a waste of time. Yeah, you're gonna get paid more than you did when you was at your 9 to 5 job. However, you're still exchanging your time for money because you have to sit there, you know, manage your trades every day. You know, you're getting up early. You can't lie in your bed. You know, you're there to, you know, sweating and panicking, watching the charts go up and down. It's getting closer and closer to your stop loss. Then it comes back again. It's getting closer and closer to your take profit line. So you're sweating all day. You know, by the time the day's finished, maybe your day finishes, you know, around maybe 3 in the afternoon or something. You know, most of the day is gone. You're stressed out. All you want to do is go and relax, right? So you've essentially exchanged one job with your boss for a job with yourself, but you're still working a job, right? So the reason why you want to do long-term trend trading, where you enter into a trade and maybe you stay in that trade for weeks, months, even possibly years, is because you get your time back, right? With focus on investing in our long-term trend trading strategy, you can make a salary or an income by only working 20 minutes of a day. When we're talking about our focus on investing strategy, all you're doing is working 20 minutes of a day. And technically, you know, all that 20 minutes of the day is spent doing is having a quick review of charts. We teach you how to learn the skill of analyzing charts and analyzing charts quickly, right? I can look at a chart within 5 seconds, not even that, 3 seconds, and I can tell whether it's a good investment or not, right? With focus on investing, we're teaching you the skill set to have that speed in which to analyze a chart and be able to know if this chart is a good asset to invest in or it's a bad investment to invest in, right? So you need that speed because the quicker you can identify whether it's a good asset to go into or not, the more time you get back in your day, right? You recoup or recover your time in your day, and it becomes more efficient. You're making money. Your money making becomes more efficient because you can identify a trading strategy quicker. So if you can go through your charts quickly, identifying good investment opportunity, and you know the straight, you have indicators like this telling you exactly on the chart where to enter, where to place your stop loss, and where to take profit at. How you don't have to sit there calculating how far, how many pips or points away from price you are. You identify that this is a trade you should invest in. We have our indicators that let you know, also that whether or not this is a good investment to invest in. We have our, what we call our BOI, or our BOI, our breakout indicator, which are these little red dots above the bars, or these little green dots above below the bars. These ones indicate whether or not it's a good bar to enter into or not. So number one, we've identified within 5 seconds that it's a good asset to invest in. We've identified what bar we're supposed to enter into, or what candlestick, because of our BOI, or our breakout indicator. And then we've got our specific entry positions already pre-calculated for our specific asset, right? So imagine how quickly you can enter into a trade by doing that, right? So this is how you make your trading more efficient. You save more time in your day by having everything already pre-calculated and configured for you, and all you do is just enter your trade, right? So most of your day when you're doing long-term trade trending, which is the focus on investing strategy, is quickly reviewing the charts. If it's a good chart, you enter into the trade, and then after that, you spend a few minutes just monitoring your trade. You might need to make a little movement on where your certain positions are on your asset, and that's it. Most of the time, it takes you 20 minutes a day. Put one in the chat if you would like to have an above earning average salary for just 20 minutes a day. Throw your ones up if that's something you would like to do. If you would like to have an above average salary for just working 20 minutes a day and working in the comfort of your own home, we're talking about you not having to commute to work in the hustle and bustle of traffic, go and listen to your boss, be getting told when you can eat lunch, when you can take a break. Yeah, D says one, it makes sense, right? Of course it makes sense. You're leveraging your time, for the smallest amount of effort for the maximum amount of profit, right? So this is why we do long-term trend trading. If you're doing day trading, you're spending your time looking at charts all day. Again, ain't nobody got time for that. Nobody wants to do that all day. You want to be on the beach somewhere sipping pina coladas or whatever your drink of choice is doing while your money is working for you, right? This is what you want to do. You want to put your money to work so that you don't have to, right? So this is why we also choose long-term trend trading. And here's the thing, right? People think that because you're entering into a trade daily, that you're getting more money. But a study was done, or an experiment was done between those who do day trading and those who do long-term trend trading, and it works out about the same. You make about the same amount of winning trades, or the same amount of gains and the same amount of losses. Why? The reason why you do that is because all you're doing when you go down time frame, or when you do smaller time frame of trading, you're entering and exiting the trades quicker, so you're doing more trades and you might be having more winning trades. But because the volatility is increased, the movement is smaller, right? When we're looking at long-term trend trading, like if we zoom out, this is the, what time frame did we say this was? This was the 1 minute time frame, and this is the daily time frame. So let's say the 1 month, the 1 month time frame is here in our top right corner, sorry, in our top left corner, and our 1 minute is in our bottom right corner. Jeez, top right, top left, and bottom right. Excuse me. And we can see that, look how long it takes for the monthly time frame to rise up and pull back. It's taken months. This is, if we look at from 2014 in our window, from 2014 to 2022, and then we got our pullback. It took years, whereas here we're getting pullbacks by the second. Remember, each one of these is a 1 minute, so each one is by the minute. So over a few minutes, between 10 minutes, we've had a rise and a pullback, right? So you'd have been entered. The pullback would have taken you out of the trade, right? The pullback took years to happen here in our chart, here in our specific chart, from 2014 to 2022, which is, well, how long is that? 6, 7, 8 years. 8 years for a pullback. Whereas here we've had a pullback in 10 minutes, right? So you'd have been entered into the trade and exit into the trade within 10 minutes, right? So you would have entered in the trade and exited the trade quicker, but the price movement is a lot greater over the greater time frame, because remember, it's a fractal. It looks the same on different levels, but as you scale it up, you're also scaling up the price movement, which means you're gaining more pips or points, or you're gaining more dollars, because there's more price moving, right? So over time, all you're really doing is, on the smaller time frame, is breaking up the price movement of the longer time frame, right? You're just entering in and out of the trade more quickly, but you're still capitalizing off of the same price movement, right? But the difference is, as you go in and out, you could go in and out on a trade, hundreds of times over the years, if not thousands. Where if you're trading on a higher time frame, on this monthly time frame, you'd have gone in and out of the trade once and only paid one set of fees and commissions, versus the hundreds of times you've paid commissions on the daily time frame, right? So this is again why we prefer doing long-term trend trading as opposed to the smaller day trading, which makes you pay more commissions over the same time frame, right? And again, the other thing is as well, it's hard to get longer term. Like we spoke last time we did our live stream, we spoke about the risk reward. It's harder to get an infinite risk reward, meaning getting infinite return on profits, when you have such a small time frame, because the volatility is so high. You're more likely to get stopped out of your trade quicker than if you're having a long-term position. You can have a better setup with your entry, your target price, and your stop loss price over a longer time frame, because there's less volatility and you can stretch it out for longer. You can capture the whole movement of price, right? Over a long-term time frame. The whole idea of trading is to spend as much time in the market with price moving in your favor. And you can see that through these long sweeping movements of price, with these janky little up and down volatility prices. There's no long trend or no long sweeping for you to capitalize and make money month on month with, right? So again, you're cutting your ability to increase your return on your profits, because there is much more pullbacks and much more stopping out of the trades, versus the long-term trends, right? So again, this is why, again, we like, or we prefer long-term trend trading over day trading. Let's recap let's recap the 3 points that we said. We said that we don't like it because it's higher on commissions. The other thing we don't like is because it takes up more time. You're going in and day out based on the trades. And also we don't like it because it caps our unlimited infinity and beyond returns on the trade, right? So those are the 3 reasons as to why we don't like day trading over trend trading, and we strongly recommend and strongly encourage you on how to do trend trading. All right, does that make sense? Does anybody have any questions on what we just covered? If you've got any questions, put it in the chat and let me know. Anything I covered that wasn't clear? If what I said was clear and people understand, throw your ones up in the chat. Again, if you haven't done so already, please hit the subscribe button. Also hit the like button when you come through the doors. And if you would like to support the stream, you can hit the Cash App, £, focus on investing. That's the Cash App, £, focus on investing. If you found the information informative, please help support the stream. Again, if you have any questions on anything we just covered, if there are no questions, Mo says a 1. That's good. D says 1. Mo says 1. If there are no questions on what we covered, we'll go into comments, questions, and concerns. Is there, any questions on what we've just covered? If not, do you guys have any general trading questions? Do you have any, stocks that you would like me to cover? Any comments, questions, or concerns? Anything you want to go into in general terms of trading or investing? We're going to have a little question and answer for the rest of the sessions. If you have any questions about anything we covered today, or about any, it could be anything in terms of, trading. I'll give you guys a few minutes to put your questions in the chat. If you want to discuss trading strategy, trading setups, elements of trading. Let me know. Put it in the chat, and we can deep dive. If there's any particular stock or asset that you would like me to analyze for you, let me know. We can put that in the chat. We could do some technical analysis. Any chart that you'd like me to analyze, any strategy you got any questions on. No question is too big or too small. Whether it's a complex question, whether it's a simple question, maybe you're just getting into trading and you're trying to get some understanding of some basic things, we can cover that. If you're more interested in a more advanced technical trading strategy, let me know. We can answer those questions. If you want to comment on anything that we've covered today, we can do so. So D has a question, which is, why is Ethereum popular? So Ethereum is, let's bring up Ethereum on the charts just to see what we're talking about. What you talking about, Willis? ETH. Ethereum. So this is the chart for Ethereum. Why is Ethereum popular? Ethereum is popular because when you're talking about cryptocurrencies are built on what they call a blockchain, right? a blockchain, for less of a better words, or of a simplistic idea. Blockchains are like the internet, right? So there are various different frameworks in which the activity of these trading takes place, right? And Ethereum is so various different cryptocurrencies have different functions, right? Some are just a store of value. Others are actual frameworks like the internet where you can do things on, right? So when the internet was first conceived, people didn't really know what it could be utilized for. A lot of people, when they came to thinking about the internet, people were thinking you would just use it to send messages to people on message boards. But nowadays, we're doing Netflix and various different things on these different blockchains. When we're looking at these different blockchains, they all have different use cases as to what they can do. Some of them are just for trading money. Some of them are for validation and different things. Like, even when you're talking about Nike, or what we would call Nike, they have certain cryptocurrencies or blockchains that are for you know verifying whether or not your sneakers or your trainers, as we would say here, are authentic or not. So there's various different use for them. Ethereum has a framework that can be utilized by many different other cryptocurrencies. It's actually one of the main. No, it's not even one of the main. It's like the main framework that activity takes place on with cryptocurrencies. Now, it's not the only one. There are other ones, but Ethereum is the main framework in which activity takes place, right? So it's the main internet, for lack of a better word, that all activity takes place, right? And on that framework, you can do different things, like you can have apps or applications and different things like that. But here's the thing, right? In order to make any sort of transaction or to have any sort of activity on this framework, you need to pay what they call gas fees. So they call them ETH gas fees. So ETH gas fees are Ethereum gas fees. So it's essentially the fee that you pay to make a transaction on this network, right? And let me bring up the prices for ETH gas fees so you can see it. ETH station. So here is a website that tells you. Let me share my screen. It tells you the exact current price of Ethereum, right? In terms of gas fees. Where are we? Here. So this is the website. This website is called ETH Gas Station, right? And it's telling you, so in order to get your transaction processed on the Ethereum blockchain, you have to pay in order to get the process or the transaction completed, right? So this website is telling you what the gas fees are. So it's telling you that the base fee is 45. I think this is in Gwei. So the value of 45 Gwei, which is a fraction of a whole Ethereum, is $2.96 per transfer, right? I'm not sure what this base fee is representing, but the standard transfer fee is 13 cents. So if you wanted to have your transaction completed in less than 5 minutes, it would cost you 13 cents, right? If you would like to have your transaction complete faster, you can pay a little bit more on the network and have it completed in less than 2 minutes for 13 cents. And if you want it to go, safely, but at a lower cost, you can get a transaction completed in under 30 minutes for also 13 cents. So there are various different um, prices depending on what your transfer is. I think this is the way this is being described is described, relative to the amount that you're transferring, right? So I think it's a 13 cents per transfer, but then they're saying the overall base of your transaction is 296, right? So I think it's like the minimum fee you pay is 296, but for each coin that you're transferring, it's like these prices in between, right? So you're talking about paying a fee for trading. We can see also there's a part on this site that tells you what the gas prices are. It's telling you what the median wait time is. So it's 15 seconds per block. Basically the 15 seconds for time it takes to create one of these transactions, and it's telling you how much the gas is being used, which is supply and demand. The more supply there is, the cheaper the price. The more demand there is, the higher the price goes up. It also gives you, how many transactions are going and the confirmation time by gas price. You can actually see like leaderboards and things like this telling you, who's the greatest miner and things like that. There's even a section, I'm not sure if it's on this, it's not on this chart, but you can get charts that tell you exactly what time of day is the best time to transfer. What's the best time to make a trade, right? Because the gas price changes depending on the time of day, because the supply and demand changes by the time of day as well. I'm trying to see if there's an area on this site. I'm not sure if it's on this site or there's another site that tells you exactly what time of day is best for you to trade. Might be under Ethereum prices. Nice. On another site, I don't have it in this browser. Yeah, so basically, the reason why Ethereum is so popular is because if you mine Ethereum, as a miner, you end up collecting the fee. So whatever the fee was at the time to form that block or to create those transactions, as a miner of Ethereum, for mining or creating that block in Ethereum, you end up getting to keep all of the fees that were paid in order to create the transactions that form that block, right? So Ethereum is popular because it's one of the first blockchains that have really been utilized, that people really utilize in order to make most of their transactions on the blockchain. But also because it was one of the first, there's so much activity that takes place on that blockchain, and therefore people want to invest in mining that blockchain because there's more likelihood of gaining those fees for that specific blockchain because there's so much activity on it, right? You also said, why is XRP popular? XRP is popular because XRP has a cult following, right? The idea of XRP is it's supposed to replace the SWIFT protocol. Now, what is the SWIFT protocol? The SWIFT protocol is essentially the protocol that Visa and MasterCard utilize in order to process transactions. So the SWIFT protocol will be our equivalent that we use today of Ethereum, right? Ethereum is what processes transactions on the blockchain. The SWIFT protocol is what processes transactions through credit cards and debit cards, right? So that's the SWIFT protocol. XRP is supposed to be, remember I told you that each different blockchain has a different function. The function of the XRP blockchain is to process transactions. So essentially you will own a piece of the network that processes all the blockchain or cryptocurrency transactions. And for each one of those, you know, each transaction that is made on the network, you earn a commission for it. So imagine, it's unfathomable how many transactions are made daily, not even daily, but a second on Visa, and how many are made by the second on, MasterCard, right? It's a lot of transactions on the Swift protocol. Imagine you got paid commission for each time, there was a transaction made, right? So this is what XRP is vying to replace, right? And, currently, as with, the majority of cryptocurrencies, we're talking about future technology. So none of these technologies are currently up and running, right? People are speculating on the value that it will bring when they become up and running. So, you got to think about the type of value that, if XRP gets up and running, then it will bring massive value. It's not only that, it's because, there's an element of it where, because it's replacing the Swift protocol, it's essentially going up against the banks, right? And there's a lot of investment when it comes to, people that are anti the system, right? Especially anti the current status quo, right? So if you're anti the status quo, you're kind of anti the bankers, right? The bankers are the ones that currently, run the world. They're the one that control, various different politics and politicians and all of these various different things, right? So because they are, we all know the whole crash of 2008, where they ruined the economy, but yet the taxpayers had to give them money to bail them out, and all of these things, right? So there's a very strong anti-bank sentiment when it comes to just the general population, right? So if you are invested in going up against the banks or trying to stick it to the banks, then XRP is something that people invest in because it's aiming to replace the bankers or banking system, right? So the reason why XRP is so popular is because people view it as a replacement for the Swift protocol, and also, a way to, you know, either get their own bank back on the banks, or get a big piece of the pie that the banks are earning in terms of, money for transactions within the system, right? So that is why, XRP is so popular. And, again, because of this narrative about sticking it to the man and going against the system, it's kind of built up a cult following. And the cult following along with it also helps to fuel the price and the activity and the excitement for XRP. All right. So I hope that answers your question. So Stun Legacy says USD JPY looks as though it has been bullish for a long time. Is it risky to make bullish trades when the trend has been bullish for so long? Great question. So let's go back to our chart. Such a great question. Remember, guys, hit the like button if you haven't done so. And if you'd like to support the stream, hit the cash app. So you said USD JPY, USD JPY. So the USD JPY is the US dollar against the Japanese yen. Let me get back to my time frames. 1 day. All right. So what we will do is we'll do a review of the charts, and then we'll go and answer the second part of your question. Let me just take a sip of water. All right. So this is our full screen focus on investing setup. We're going to start with our daily time frame. So if we look over the months, the US dollar Japanese yen has trended quite well, right, over time. It's not crazy high volatility. There's a little bit of spikes, but that's pretty to be expected. Whenever you're talking about forex currency pairs, you're expecting quite a high bit of volatility in general between the two currencies, especially depending on what currencies there are. You know, different when you're talking about different economies going up against each other, the variations between each one of them um, as individual economies can fluctuate the price quite wildly, and also the relationship between the two currencies can fluctuate volatility quite wildly. But the good thing in here is you can see how much movement there is in price, right? The difference in price or in exchange rate between the two currencies moves quite drastically, right? So this is a good thing. You need volatility in a chart or in a trade in order to make money. So a chart that has, you know, big long dips and big long recoveries is good, because the longer the dip and the recovery, the more opportunity or chance to make money there is in the trade, right? So if we look at the if we zoom out and look at the overall, you know, what you will find is with most currency pairs is they trade within a range, right? They were trading within a consolidated range. So we can see that our high in this is 147.55. So let's draw our high here, and our low is here, which is 75.791, around this area. So we can see that the overall price is bouncing in a one long consolidation between these two prices. And generally what that means is, like, the market doesn't perceive that the exchange rate should go lower than 75, and they don't perceive that the exchange rate should also not go above 147, right? Now remember, when we're at 1, it's a 1-for-1 exchange. Where we are, it's like a 1-for-1 exchange for each of the currencies, right? So what we're looking at here is over time periods from 1993 all the way up to present day, the price has fallen all the way down to, you know, our support level of 75. It's also then raised back up to our resistance level of 147, and we see quite good movement in between each one of these points. If we now remember, because forex pairs operate differently um to stock charts or stock assets, right? The idea with forex pairs, because they generally also, you know, have a lot more volatility in terms of, when you have more volatility, you have more support and more resistance levels, right? And when you have more support and resistance levels, you have price usually bouncing off of areas and much more frequently. When we look at most stock charts are a lot more sweeping, so they have higher sweeping curves. And the idea with stocks, like, let me bring up the Microsoft chart so you can get MSFT. MSFT. So Microsoft, we can see Microsoft long sweeping curves. This is since 1989 up until, you know, present day. We can see on this chart long sweeping curves. So the idea with a stock is that you get in and you ride the curve all the way to its top before it pulls back, right? If we go back to the USDJPY, because of the increased volatility, you're not seeing the same amount of large sweeping curves, right? So the trading mindset has to be different, because if you're going to look for a setup like Microsoft with long sweeping curves and long continuous growth over years, you're not going to see it, because of the increased volatility and the shifting of value between each one of these currency pairs, right? So the idea with forex pairs, you're trying to make like small amounts of money. This is kind of more akin to the day trading style of trading, where you're dipping in and out of each one of these little support and resistance pairs, support and resistance lines, right? Or support and resistance prices, right? Rather than expecting price to go on long sweeping runs, you might just be expected to, or you might be just be trying to target, you know, price movement from point to this point. We can see a sweeping up. You might want to jump in the market for a little while, capture that little amount of price movement, and hop out of the market, right? Within this, you might want to just target small little areas and sections of price movement, price raising up here. You might want to, if you're lucky, you can get a big sweeping movement, which is like between these 2 points here, right? So it's about jumping in and out of the markets on smaller price movements rather than more large sweeping price movements, because again, the nature of the chart or the underlying asset is very different in forex than it is to stocks, right? Let's go and take a look at the weekly time frame. If we look at the weekly time frame, we can see that price has risen up quite highly. We can see that, this is a quite bullish looking chart. We can see that, price is trading well above our moving averages. And we have our moving averages. We have the 50 simple moving average trading above the 200 simple moving average. We could also see, our key pivot support and resistance lines as shown here by our dashed green lines and our dashed red line. And we can see that price is trading well above those, with good space between each of these indicators. And we can also see that our trend filter is colored green, which indicates bullish price action. If we go to our daily time frame, let's go to our most recent bar. We can see that, we have our setup ordered with price trading above our 20 simple moving average, our 20 simple moving average trading above our 50 simple moving average, and our 50 simple moving average trading above our 200 simple moving average, right? And we can see the sharp, steep angle or incline of these moving averages, which is also indicating a bullish price action. And then we could also see, our green trend filter. So our green trend filter is also indicating that it's got high bullish transaction. Whole bullish price action. Sorry, and then we can see a correlation between our weekly time frame and our daily time frame, which is both showing both green trend filters, right? So overall, yes, it's very correct that this is showing quite strong bullish price action. So the second part to your question was, is it risky to make a bullish trade? I can't see. Is it risky to make a bullish trade when the trend has been bullish for so long? Now, generally in trading, we spoke about earlier how price moves, or in price in a chart never moves in one direction completely. It always moves, pulls back, or what they call a retracement, and then continues on in the forward direction, right? I always akin it to the waves of the ocean. When tide comes in, it doesn't come in one full motion. It comes in, it pulls back a little bit, it comes forward a little bit further, and it comes back a bit. It's a bit like the candy dance, right? You take a couple steps in one direction, and then a step back, a couple steps forward in that direction again, and a step back, right? You're 2 steps forward and 1 step back, right? So because of that, because there's a lot of forward and back movement, we expect that price will move, it will consolidate, and then move forward again. It will move upwards, go sideways, and then move forward again. Like, let's say if it takes, for instance, this chart here. We can see that, in this movement from 12th of August, so August 2012, which is $78, or at the 78 exchange level, to the 130 exchange level, prices moved up in a bullish direction. However, it's not moved in one straight line, right? It's moved up. Now remember, this is a forex chart, so I'm just using this for illustration purposes. It's moved sideways, and then it moved up again, right? So you find that with most stocks, they go on a run, they consolidate sideways for a while, and then they spike up again. And historically, we've seen that the longer the consolidation or the longer the sideways movement on the chart, the more likely that it is to the longer it's gonna go in a trending direction, right? So for when you're looking at entering into a stock, you're absolutely correct. It's very risky to make a bullish trade when the trend has been bullish for so long. Reason being is, if a trade has been bullish for a long time, it's likely that it's coming to the point where it will move sideways in consolidation. See, most people make the mistake that, and I have a saying that you can't make money off of past price action, right? Most people make the mistake that they look at a chart, they see a lot of run of green price action, and they think that, oh, because it's trended quite well, if I enter into it now, somehow I'm going to capture similar price action from the chart. When in reality is, it's more likely that after a certain period of time, when it's been a long run on price, that we're more likely to be coming close to an area of consolidation where price is going to start moving sideways, and we're not going to be making money because our money is going to be tied up in sideways movement, right? So that's what happens, or is more likely with stocks. However, because we're talking about forex pairs, they operate differently. So it's not such expected that we're going to get long runs of price movement or price action, right? The idea is that you want to try and capture price between each one of these support and resistance levels, right? So let's see where we're at now. We've got a resistance level here, which can be a support level. So we've broken and closed above our support level. So where we would ideally be looking for is to see price move to our next support and resistance area, or support and resistance level. Now, due to our focus on investing key pivot support and resistance levels, we can highlight where these areas will be. So we can see this green dash line. The green lines represent, for this particular asset, an area of resistance. So we'll put that in. And we've got another area here. So the idea with forex trading is that you want to capture price movement in between each one of these support and resistance levels, right? So the idea is that when price breaks and close above this 125 level, the expectation is that price is going to run up to the 134 level, right? So your aim as a forex pair trader is to capture price movement between these two lines, right? So that would be your take profit line, as we spoke about earlier. Your take profit line would be the 134 level, right? Then if it breaks the 134 level, the next target price, or the next take profit price, would be to target this level here, which is the 147 level, right? So the aim with forex is to capture price movement in between each one of these levels, and in doing so, the aim is not so much of expecting big levels of movement and then consolidation. The aim is really to capture price movement in between each one of these lines. And if we go into the chart and kind of capture or highlight where all of these support and resistance levels, or the key ones, are, you will notice that when price moves, it generally moves and stops in between each of these price points or these levels, right? Um, yeah, these are the main ones. Yeah, you've got a few here, but yeah, let's leave it at that. So you notice when price moved from here, it moved down, stopped at the line, moved up close to the line, moved stop and consolidated along the level of the line. It came down, hung a bit of this level of this line. It actually spiked down like it wanted to go towards this line as well. On the way up, we've got an area of consolidation here as well. Now remember that support and resistance are areas and not specific lines. So when it might come close to the line but not exactly touch the line, right? We see this movement here. It came up to the line, came back down to the line, came back up to the line, came back down to the line, up to the line, down to the line, up to the line, down to the line, up to the line. And you can see this repeatedly going through the whole history of this asset, that it tends to move towards the line. So this is why when we're talking about forex pairs, we're trying to target price movement in between the lines, right? So we expect that if price breaks and closes above one of these lines, the next likely position for it is to go ahead and hit one of these next lines. So what we're trying to do with forex pairs is enter after price breaks past the line or breaks and closes above the line, and then take our profit as price closes into the next line, right? So this is the aim of forex trend trading, or forex trading in general, is capturing the small price points in between support and resistance, rather than trying to capture the money on the long sweeping trends as we would do with stocks. So so to answer your question, is it risky to make a bullish trade when the trend has been bullish for so long? Yes, on stocks, but no on forex pairs, right? No on forex pairs, because we're not expecting long sweeping movements and then consolidation and then long sweeping movements. All right. So did that answer your question, Stun Legacy? I hope it did. Our next question is from D again. And D says, what is your take on Bitcoin Cash? With cryptocurrencies, you have what they call forks. So essentially, cryptocurrencies are code, right? And a fork in the code is when the development of the code is updated to a certain level, and then when you get to a certain point, the code splits off into two different directions. So two different sets of people might want to evolve the code or update the code into different directions, right? So a lot of these cryptocurrencies you'll find will have derivative forms of the original underlying asset or the original cryptocurrency, right? You're welcome, Stun Legacy. So what you'll find is when they have derivative forms of each one of these cryptocurrencies, you generally still have the core or original cryptocurrency or the original code of the asset, and then you have the derivative of the asset. So the original underlying asset would be Bitcoin, and the derivative would be Bitcoin Cash, right? So it's like a fork of Bitcoin, right? So it's a derivative of Bitcoin, right? So what typically tends to happen, there is some, it ends up, sometimes there's some mirroring of the movement because of its underlying asset is the original one. Sometimes you get a reflection in the movement of derivative, which is similar to the original asset. But also what you get is you get the credibility or the clout. Oftentimes when you have the name of it, if you have Bitcoin is the original cryptocurrency. Bitcoin is it's the most popular cryptocurrency in the world, and it's the most highest valued cryptocurrency in the world. So when you have a cryptocurrency named Bitcoin Cash, you're also talking about it taking the credibility or the clout from the original Bitcoin, and it's added into Bitcoin Cash. Now, again, it's a derivative, so it's not the actual Bitcoin. It's not, going to ever be as valuable as the original Bitcoin. However, because there's a sort of link to it, it's going to see some benefits from the original Bitcoin. So, my take on it is it's a derivative of a main one, as there are many derivatives. However, because it's a derivative of Bitcoin, the most popular cryptocurrency, it has some value because of its connection to that. So I hope that answers your question, D. D also says, do you watch the series Billions? Would you consider it to be realistic? Unfortunately, D, no, I don't watch the show Billions. No, I don't. I've heard about it. Is Billions? Is that the one with the Rock in it? Dwayne the Rock Johnson. I know he's in one of them. Which one is the Rock in? Is it Billions? Or I know that there's a couple of shows that are kind of similar to each other. I don't know, is it Billions? I've seen the advert for Billions or the commercial for Billions. He says, "Yeah, you're welcome." He said, "I don't think so." Which one is the one that The Rock was in? I think it's a Ballers. Is there one called Ballers or something like that? It's one about rich athletes or something along those lines. I know. I don't think it's similar to Billions, or it kind of to me. There's a lot of these TV shows that look similar. They kind of had the same kind of look about them. I don't know. I've never seen Billions, but I think it's about investing, about rich people in investment funds. But I've never actually seen it. He said a ginger European male was the lead. Okay, I'll check out the trailer for it on YouTube. And was there a specific? Oh, you was going to ask if it's realistic. I can't really tell because I don't see it. But typically, whenever you're talking about when you're talking about TV shows, it's probably dramatized. Yeah, Ballers. That's what I said. The Rock was in Ballers. He said The Rock was in Ballers. Yeah, that's the one I was thinking of. I think Ballers. I don't know if you watch Ballers, but is it similar looking to Billions? Like the same kind of style of, videography and cinematography. It's got the same similar style. Yeah, I would typically expect that, if it's a TV show, it's going to dramatize what trading is like. But having said that, the trading industry is quite wild. I don't know if you've ever seen Wolf of Wall Street with Leonardo DiCaprio. Um, you know, you can see some of the wild parties that they have in the series. But what is funny is a lot of that is based on true life. Like there's something about people when they get so much money. Again, this is when you're talking about leveraging your money. They exchange time for money, but because they earn so much, having that amount of money when you're a trader, if you're not grounded, you don't have a proper ground like mentally and a proper solid base, it could turn you crazy. So this is why a lot of them get addicted to drugs and start doing wild stuff and all these things, is because of the lifestyle is very wild when you're talking about one of these high traders, right? So I don't watch the show, so I don't know how wild it is, but it gets quite wild. um you know on our trading academy or focus on investing, like we have some videos on there that deal with like the traders or investors mindset, and we have some videos in there with traders that talk about the lifestyle of trading. The lifestyle of trading is very free, right? Because you get a load of money with little time commitments, and you can work as long as you want to. D says European behavior is amplified. Yeah, but the thing is as well, when you get a certain amount of money, it doesn't only amplify European behavior. It will amplify who and what you are, right? The more money you have, the more amplification of your true nature and your true character will happen, right? So you get real extreme behaviors when you're talking about the investing industry, right? And a lot of these investors, like they're doing wild parties, drugs, hiring ladies of the night, let's put it that way, because we don't want to get flagged by YouTube. There's a lot of wild things. There's traveling. A lot of them work like Fridays is half day if they work at all. They come in just so that they can meet and go to a bar and get drunk and all of these different things. But this is part of the trader lifestyle, right? All of this is encompassing when you have lots of money, lots of freedom, and not much time commitment. These are the things that happen. And this is what we're aiming for with trading, right? When we teach you with focus on investing, we're teaching you to have a high return on your time, right? You're spending 20 minutes a day, but earning, what some people earn in a salary may as a year, in a month, or maybe in even a week, depending on how good your trading becomes, right? So this is the aim of learning how to do long-term trend trading, is to learn how to leverage your time as most efficiently as possible to make that amount of money. All right. So, if any of you guys would like to learn all of the trading strategies and also the mindset behind trading, you can go to focusoninvesting.io. That's again focusoninvesting.io. And there again, we have our full investment syllabus, which teaches you all the ins and outs of the trading strategies, all the specific little elements. We also give you access to all of these custom coded trading indicators that allow you to analyze charts in seconds and let you know whether it's a good investment or not. We also provide you with trending asset lists, so trending stock lists, so we can tell you which stocks are the good ones to be invested in or which ones are trending currently. We also have premium stock lists where we basically give you the exact stock to invest in and the exact price to buy it at, and we give you obviously our 3 key prices or key 3 price points, which is our entry, our stop loss, and our take profit. And yeah, also if you're interested in doing like one-on-one coaching and setting up one-on-one consultations, we also have the ability to do that on there as well. Once again, if you haven't done so already, please hit the subscribe button. Also hit the like button. And again, if you'd like to support the show, it's Cash App £, Focus on Investing. Again, Cash App £, Focus on Investing. And yeah, if you would like to join us again for next week, we're around at 8 p.m. British time, GMT, 3 p.m. Eastern time, and 12 p.m. Pacific Standard Time. All right, ladies and gentlemen, thank you very much for joining me for another trading session on a Sunday. And I hope you guys have a blessed week. Take care. Peace.